بسم الله الرحمن الرحيم. الحمد لله والصلاة والسلام على نبينا محمد وعلى آله وصحبه أجمعين. السلام عليكم ورحمة الله وبركاته. Welcome to chapter 18. Today's topic is long-term financial planning. So let's start. Financial plans establish a firm's financial goals and provide a benchmark to evaluating performance. So today we'll talk about financial plans, how as a company or as a managers, how we plan for our future. Okay, and we are talking about the financial plans. Normally in the financial plan we put our financial goals, like for example, if our goal is to have $100 million sales, this is we will put it in the plan. So we say our plan for next year, we need sales to be 100 million. Okay, so this is the plan. You put the financial goal in the financial plan, and the financial plan is also important because it provides a benchmark for evaluating the performance. Like after 1 year we will check how much our sales, the actual sales, then we compare it to the plan, right? Then we see whether we hit the target or not, whether we satisfied the target or not. So this will give us actually as a reference to evaluate the performance of the management, whether they were able to generate the financial goals or not. Okay, so in this chapter we will analyze the long-term financial plans and the provides discussions of the growth for the company. Okay, firms plans for both the short term and long term. When we say financial planning in the terms of sales or any financial goals, we are talking about short-term goals and long-term goals. Okay, short-term goals basically the plans for the next 12 months. So plans on how much, for example, cash we should have in the next 12 months. So this is anything less than 12 months, right? We call it short-term planning, and we plan for something called working capital, which is basically the current assets, the current liability. You need to plan how much assets you need to have, how much liabilities to have in only 1 year. This is we call it short-term. And long-term plans that exceeds the next 12 months. If you have a plan for the next 5 years, 6 years, this is we call it long-term planning. Okay, and normally when we take long-term planning, we are planning for 5 years. We put some strategies for the next 5 years, then we will see how to implement them. Okay, long-term planning focus on several things. First of all, we focus on long-term financial goals. We need to set the goals exactly, specifically how much we need to have sales, how much we need to have as net profit after you are paying all the costs and taxes. Like for example, if you want 10 million, this will be your financial goals. Also, okay, the long-term financial planning specify what investment required to meet these goals. So first of all, we will set the target, our goal. Okay, then in order to reach the goals, we need to make some investment. Like for example, you need to invest in new products. You need, for example, to sell your product in new markets and other things. So here we need to know what investment are required in order to reach our goal. Then also we mention the financing that must be obtained. Okay, so now you have a goal, you know you need to invest, but the next question is how to raise the money. Should we use our own money? Should we issue shares? Should we take a new loan in order to finance our investment? This is also mentioned in the financial planning. The last one, the dividends policies. So we need to be clear, okay, what are our dividend policy? Do we need to pay all our earnings, or we return some of them, or we pay, like for example, 50% as dividends? We return another 50% to invest or any compensation. So here we need to also to put our dividend policy. And the last thing that we need to mention in the long-term planning is the debt ratio. How much that we should have in our balance sheet. So those items you can find it under long-term planning. They are easy. You need your financial goals, then some investment to approach the goals, how to finance your activities, dividend policy, and how much debt you should have. Okay, now let's focus on the big picture. Financial plans combine the plannings of managers at every level, but they also reflect senior management strategic plan. So in our financial planning, we normally aggregate the planning from managers at every level. Like for example, we have financial managers, we have protections managers, we have different types of managers, manufacturing, whatever managers. So we will take, okay, the plans from each of them. We will put it in one. We call it a strategic plan. So in general, firms don't plan on a project by project basis. It's not like for every project. We need a plan. Okay, we normally have our strategic plan at the beginning of the year, or at the beginning of this year for the next 5 years. Then we work toward our goals. Okay, and small projects normally aggregated and treated as one large project. For example, we may have 3 plans in one. Like for example, in your plan you may put some scenarios: the best cases scenario, normal growth scenario, and worst cases scenario. Now, because we are talking about the future and a future is uncertain, we need to put some scenarios with the probability. Like for example, you can say the best scenario, if we have a good economic growth, then our sales will be 100 million, like for example. Another scenario, if we have just normal growth, our sales will be maybe 70 million. Worst case scenario, if we have a recession, or economic downturn, then our sales will be, let's say, 30 million. So you will put some scenarios, and this is what they do in the real life. You need to put or you need to prepare for everything, especially now in COVID-19 era. Next, why we build financial plans. We have here 3 reasons. The first one, contingency planning. So financial plans allow managers to formulate quick response to inevitable surprise. When you have a financial plan, it is easier and quicker to move if something happened in the market, right? Like for example, 2020, we had a COVID-19. Many companies, they have already some plans before 2020, and they were planning for higher sales. But because of COVID-19, they reduced their sales. Now they have the plan in front of them. Okay, this helped them to quickly formulate some strategies in order to reach their goals. Okay, so when you have a financial plan, this will help you to formulate a quick response to any emergency. Okay, second reasons, considering options. Financial plan often include plans to enter a new market for strategic reasons, not due to an immediate positive MBV. Now we normally invest in projects if the MBV is positive, right? If the project adds value to the company, then it's better to invest on it. If we have negative MBV, we reject the project, correct? But also sometimes we take some decisions. We call it strategic decisions. Like for example, if you want to move to a new market, even though you know the sales at the beginning it will be negative, or negative MBV, still you go for the market because you have some future potential. Okay, the last one, forcing consistency. financial plans force managers at all levels to commit to the same standards of measures and success metrics. When you have a financial plan and you distribute this one to all managers, to all employees, okay, then everyone will work in the same goals, right? Everyone have the same standard. We measure their performance and their success metrics based on the goal because we have something, and everyone is working toward that goal. This is why we need the financial plans, especially the long-term financial plans. Okay, now let's talk about the financial planning models. Financial planning model helps planners explore the consequences of alternative strategies. And this diagram illustrates the process. Okay, so what we have here, we have inputs from the left side, then you have the planning model in the middle, then you have the outputs. So it is easy. You need input, put it here, then you will have the output. In this case, our inputs is the current financial statements. Okay, we already have the historical financial statements, this year's and last year's and the year before. So we have it, right? We have all the accounting numbers inside those statements. So based on the current financial statements and the forecasts of key variables such as sales and interest rate, we put it in our model, in our equations, and this will give us the outputs, which is basically the projected financial statements. We call it performance, okay? And we will have some financial ratios and sources and uses of cash, right? So this is a process. You need historical informations or historical accounting numbers, some forecasts about our sales, about the interest rate, about some economic factors, what will happen in the future. Then if you put it in the model, this will give us an idea about the future financial statement, what we are expecting for next year, for the year after, for the next 5 years, and so on. Okay, the effect of the change or of a change in sales on working capital will be seen in which sections of financial plan. Output, because the input is sales and it will need a chance in working capital. Okay, now we were talking here about planning model. Okay, we will talk about the first one, which is a percentage of sales models. Percentage of sales models, we basically here planning model in which sales forecasts are the driving variables and most other variables are proportional to sales. So basically, if you have income statement, you have the first item sales, the next item, for example, cost of goods sold. So now if the item in the balance sheet we make it as a percentage of sales, it's like you divide every item by sales and it will give you a proportional compared to sales. Now we have example after few slides inshallah, but for now let's just go through the theory. Now why we need this model? To make everything as a percentage of sales. It is very useful model because it is the quickest way to develop a forecast about the future. It helps us to compare different companies with different sizes. Even if we have a company, the sales of that company with $1 billion and the other company that sells is just in just a few thousands. When you divide as a percentage, you take off the effect of the size. So this will help us to compare different companies together without any bias. It can yield high quality forecasts for those items that closely correlate with sales. We have another item here called balancing item, variable that adjust and maintain the consistency of a financial plan. Later on inshallah we have example. I will explain this more. So basically if the assets is not equal to liability plus owner equity, then we need to add something called balancing item. It's also called plug item. We have here one example. It's a very important one. a forecast using a percentage of sales model, expected sales to increase by 12% annually over the next 5 years. If costs are proportional to sales at 80% level and last year's sales were 1000, what is the projected net income in year 5? Okay. So the question is, what is our expected net income after 5 years? What do we have here? We have sales. This sales expects to growth at 12% every year for the next 5 years, right? Another item here given, which is the cost. Cost will be always 80% of sales, and the current year's sales is given 1000. So we will do this one in 3 steps. The first steps, let's calculate what is the expected or projected sales in 5 years. After 5 years, what will be the sales? Think about this one. We have today the sales is $1,000, right? And according to the questions, the sales will grow at 12%. So we will multiply the $1,000 by 1 plus 12% by 1.12. Now we need the power 5 because we are looking for the value after 5 years, right? So use your calculator to calculate it. Since after 5 years, at least equal to sales this year's, multiply by the growth 1.12%. Okay, but this is to the power of 5. Do the power first in your calculator. 1.12 shift the power of 5. The answer, multiply by 1000. You will get the sales after 5 years. But we are not looking for sales. We need net income. So you have to calculate the expected cost of goods sold in 5 years. Same way, same methodology. So what are you going to do? You have cost of goods sold in 80% of sales, like 0.8 of sales. What was sales? 1000. 80% of 1000, this will give you 800. But this is still the cost today. And we are interested after what? After 5 years, right? So again, multiply the 800 by 1.12% to the power of 5. This will give you the cost of goods sold after 5 years. Now, we need the net income. And we know what is the net income, right? Net income is always sales minus cost of goods sold. This is the actually simple one, right? I put the equation for you in the slide that I highlighted in yellow color. So net income equals sales minus cost. Okay, so first of all, you need to find the sales after 5 years and the cost after 5 years. Then deduct them. This is very simple for you. Next, we have also this example. This is also important. Assume this year's financial statements are as follows. So what do we have here? We have the income statement 2011. We have balance sheets 2011. Okay, and the questions is calculate the pro forma statements or future statements for 2012. We need the project income statement and the project balance sheet for 2012. And here we have some assumptions. Assume sales and operating costs are expected to grow at 10%. Interest rate will remain constant. The firm will continue to pay 2/3 earnings in dividends, and the last assumptions, the firm will need 10% more fixed assets and net working capital next year to support the higher sales value. This is very important questions. So we have the current balance sheets and the current income. We need the future one. Easy, because we have some assumptions already given in the questions. So let's just start. So here I want to construct again the same items. Okay, so but before 2012, let's start with the first one, which is revenue. Okay, what was the old revenue? It is here, $2,000, right? Put it in your calculator, 2,000. Now this revenue will grow at what? At 10%. So in your calculator, the 2,000 multiply it by 1.10, then the answer will be your item is 2,200. Okay, so which is this one that I highlighted in green color, $2,200. You will do the same for the cost of goods sold. Okay, so the old one is 1,800. Multiply again 1.10 according to these assumptions. Everything in sales and operating costs grow at 10%. Okay, so the item is 198 that I highlighted in pink color. Now you have revenue 2,200 in the highlighted in the green color minus 1,980 that is highlighted in pink color. The remaining 220, right, that I highlighted in yellow color. Okay, now interest rate, we said no change, right? According to the assumptions here, no change. So we keep it as it is, 40. Then you calculate earning before tax. Earning before tax is what? Is equal to EBIT, earning before interest and tax, minus interest. This will give you earning before tax. Calculate the tax, which is 40% of earning before tax, as mentioned in the questions. This is given, 40%. Assume it is given. This will give you $72. Okay, so 0.4 multiplied by 180 in your calculator is equal 72. That I highlighted in orange color. Now we need net income. What is our net income? So it is 180. This is earning before interest that highlighted in the blue color. Remove the tax that I highlighted in orange color. This will give you a net income 108 that I highlighted in light gray color. Okay, now the dividends, okay, they mentioned here. Okay, it will be 2/3 of earnings, right? 2/3 of earning. So here you will divide the 2 divided by 3, then multiply the answer by 108, which is our net income, right? The light gray color, and the answer it will be 72 that I highlighted in purple color. So what does this mean? This means the company is going to distribute 2/3 of their earnings as dividends, which is equivalent now here to 72 million. Imagine these numbers in million. Now after you deduct the dividends, the remaining will be 36 that I highlighted in red color, okay, which is the net income that I highlighted in light gray color minus dividends that I highlighted in purple color. Okay, so you can see it is easy to calculate the project income statement. Okay, you need now just the rate that mentioned here in assumptions 1, the growth rate, which is 10% multiplied by sales multiplied by operating cost. Make sure the interest rate constant because there is no growth in the interest rate. Check what is the company policy for dividends. Okay, and this will give you the last item here that I highlighted in red color. Okay, now we want to do the same for the balance sheet, correct? Okay, now the old one, or the old balance sheet net working capital was 200. Okay, now what we mentioned here, assumptions 4, the firm will need 10% more fixed assets and 10% more capital. So again, you multiply it, okay, by 1 plus 10%. So in your calculator, $200 multiplied by 1.10 equals, okay, 220 that I highlighted in brown color. Okay, so we'll do same for fixed assets. Okay, 800 multiplied by 1.10 equal 880 that I highlighted in equal color, and net working capital plus fixed assets, this total assets 1100. that I highlighted in dark pink color, right? Okay, now for debt. Okay, nothing mentioned in the assumptions about the debt, so put it as it is. Okay, we have here 400. Now shareholder equity. Okay, the previous one was 600. Okay, the new one will be 600 plus this 36 that I highlighted in red color. Why? This is from accounting, right? If you want to know what is the new shareholders equity, it's equal to the old one plus any additional or additions to returned earnings. We move it to shareholder equity. So the new one, 636, that I highlighted in light orange color. Now if you add a liability, okay, plus owner equity, this will give you 1036 that I highlighted in dark green color. According to the accounting equation, okay, this should equal to what? This should equal to total assets here, but it is not equal. So we have here total assets 1100 that I highlighted in dark pink color, and we have total liability and shareholder equity here only 1036 that I highlighted in dark green color. So what is the difference between them? The difference is 64, right? This is, we call it balancing item. So our balancing item will be $64, which means this is the required external financing. We need at least 64,000 or million, depend on the balance sheet, depend on the numbers here. We need extra 64, let's say $1 million, to finance our activities, to like in order to have the growth rate here, okay, 10% in our sales. Okay, again, this is the same. I already explained it. Assume the firm use debt. Okay, we said here we need 64 million, right? Okay, so assume the company now will take a loan for 64 million in order to finance their activity. Okay, we talked about the model, which is the percentage of sales. Now let's talk about some limitations of that model. First of all, percentage of sales models have unrealistic assumptions in details. Okay, in reality, assets may not be proportional to sales. Okay, so when we say the assets will move with the same percentage as sales, this is unrealistic. Sometimes it moves higher or lower. I mean the growth rate. Fixed assets aren't added in small increments. So here we assume the fixed assets will grow at 10% or whatever the percent, okay? This is not realistic. Percentage of sales models don't adequately account for increases in fixed assets. Number two, planning models don't tell which plan is the best. So we have planning model, but it doesn't tell us which one is the best. Model can tell how much money the firm must raise to fund the planned growth, okay, but not whether the growth contributes to shareholders' value or not. So when we have the model, this will tell you how much money you need in order to finance your growth. But we don't know whether this growth is good or not, whether this will add value to shareholders or not. Okay, this is another questions. Okay, we need to answer it by using MBV. Right. Now let's talk about external financing, because we need sometimes external financing in order to finance our growth. Okay, so here you have this graph. You can see there is an upward trend here, the blue line. So this is a project, okay, a project for a growth rate. Whenever you have higher growth rate, it's going up. Definitely you need more external funds. So in the y-axis we have external fund. This is zero external fund. So this horizontal line that I highlighted in green color represents zero external fund. What does this mean? It means we don't need funds from outside, right? So if you are working, if the growth rate is below the red point, if your growth rate is the orange point, okay, in any point below the red point, it means you still can manage it with your internal fund. Then you reach the red point where you use all of your internal funds to finance the growth rate. After that, if you want to grow more, you need to go for external funds. Okay, so always we have this positive relationship. Here we have equation required external financing equal to what? Equal to the growth rate multiplied by assets minus reinvested earnings. So this is a formula, you need to remember it. We have one example here. A firm's financial planners have projected a growth rate of 12% for the coming year. Currently, it has assets of 8 million and retained earnings of 480. The question is how much external financing will the firm need? Okay, so think of this one. We have assets 8 million, right? And we will grow at 12%. So multiply 12% by 8 million. This will give you the new level of assets, how much you need. For example, if you do it in your calculator, 12% multiplied by 8 million, you will get 960,000 in assets, okay? You need to buy them. Do we have money? We have only 480. So 960,000 minus 480 from your retained earnings, the remaining is 480. So you need external financing at least $480,000. You can apply for a loan, like for example, in order to finance your growth for this company. So now we know how to calculate the external financing. Remember this one. It's very important, always growth rate multiplied by assets. This will give you one figure, then minus reinvested earning. Okay. Now let's talk about the growth rate itself. We have two types of growth rates. Okay, we have internal growth rates and we have here substantial growth rate. So let's start with the internal growth rate. This is a formula. Internal growth rate equal reinvested earnings divided by assets. So in any questions, if you have the reinvested earnings and you have assets, you just divide the two numbers and this will give you internal growth rate. Now sometimes we don't have those information, like it is not given in the questions. So you use the second formula, IGR, which is the internal growth rate, equal to reinvested earnings divided by net income multiplied by net income divided the equity multiplied by equity. Okay, divided by assets. It is the same one. It's just different formula, depends on the information that you have. Now basically, if you think on it, net income will go with net income, equity will go with the other equity, and at the end you will have reinvested divided by asset, which is the same of the first one. Another formula for IGR, it's equal to blowback ratio multiplied by ROE multiplied by equity divided by assets. Okay, now what is the blowback ratio? We also call it retention ratio. This is actually the remaining of payout ratio. So every year the company pay out dividends, right? The remaining we'll call it a retention ratio or a blowback ratio. Like for example, if the payout ratio is 60%, this means the blowback ratio is the remaining, which is 40%. Now if you want to explain it in simple words, it means the company is going to distribute 60% of their earnings as dividends, and the remaining, which is 40%, will use it again for their internal growth rate. They can reinvest it again actually in the company. So you will have the blowback ratio, and the question if it's not there, okay, is the remaining of the payout ratio. Okay, multiplied by a return on equity, multiplied by equity divided by assets. Okay, we have one example in the next slide, inshallah. Okay, the question is, what is the maximum internal growth rate consistent with not requiring external funding for a firm reporting net income. 850,000 dividend payout ratio 35%, total assets 40 million. And the questions, what is the internal growth? Okay, you can see the formula in the slide. You need assets, you need reinvesting earning. Assets is mentioned in the questions, 14 million, so you put it down in the formula. It is easy. However, reinvested earning is not given, but we know this one, right? It is equivalent for what? Remember in the questions, payout ratio is 35%. The remaining will be 65% because always we need the blowback ratio, which is the remaining. So the remaining 65, you multiply it by what? By net income, because when we say we want to return 65%, this is 65% of what? Of your net income. So multiply 0.65 by 850. This will give you the reinvested earnings. Divide them. The internal growth rate is 3.95. Now we are done with the internal growth rate. There is another growth rate called sustainable growth rate. This is the steady rate at which a firm can grow without changing leverage. When we say leverage, it's amount of debt the company has in the balance sheet. So here we want to know what is the growth rate of the company, okay? Assuming that there is no change in the level of or the amount of debt without changing the leverage. This is the formula: sustainable growth rate equal blowback ratio multiplied by return on equity. Now, how is the sustainable growth rate different from the internal growth rate? I put for you those two notes in the slide. The internal growth rate is a formula for calculating the maximum growth rate a firm can achieve without resorting to external financing. So from the name, when we say internal growth rate, this is the maximum growth the company can do, okay, without applying for external financing. So this is only using their internal funds, okay. On the other hand, sustainable growth is defined as the annual percentage of increases in sales that is consistent with a defined financial policy. Or you can say this is the rate at which a firm can grow without changing the leverage. So still they have leverage, they have external financing, but if you don't want to change it, we want to know what is your maximum growth rate. This is the difference between the two growth. Now we have one example here. Calculate the rate at which the firm can grow without changing its leverage. Its payout ratio is 35%. Equity outstanding at the beginning of the year 8 million, net income 1,500,000. Okay, this is the formula. Okay, here you need the blowback ratio multiplied by ROE. Okay, our blowback ratio is not given here, right? But we know it is 1 minus payout ratio, or the remaining of the payout ratio, which is 65%. Now you need to return on what? We need return on equity. So what is the formula for return on equity? From the name, return on equity. So this is net income divided by equity. Net income is given in the questions, also equity is given. This will give you 18.75, and the question sustainable growth, the answer will be 12.19%. Okay, this is all for this chapter. So we learned about financial plans and how to use the percentage sales models. We learned also about internal growth rate, sustainable growth rate, external financing, and some examples of percentage of sales. Okay, thank you so much and study well, and I will remind you again, if there are any questions or any point you don't understand it, please feel free to post your questions in the discussion in the blackboard and I will answer it inshallah. Okay, assalamu alaikum wa rahmatullahi wa barakatuh.